Hi everyone. I hope you all can hear me. It's Preeti Khurana from ClearTax. Welcome to this webinar brought to you by ClearTax and Kotak Mahindra Bank. Today we are going to talk about an important topic, which is about taxes and finances during COVID-19. Welcome everyone to this webinar by ClearTax. My name is Preeti Khurana. I'm a chartered accountant. Today we're going to discuss some very relevant changes that have been made in taxes and also everything that you must know and prepare for during this period of financial crisis. Firstly, I want to thank you all for taking out time to join us during this session. This is going to be a session of learning for all of us. We will learn some new tax information. We will understand what are the various changes that have been made by the government so that taxpayers can cope through this crisis. And we are going to touch upon some important tips that you can take to have a financially secure period during this crisis. Please keep on asking me your questions and I will be happy to answer them as we go along. You can ask your questions here and I will address them as we speak. Alright, so it's time to begin. So let's first look at what are the various important topics that we are going to address today. Firstly, we will touch upon extensions in due dates and various other timeline extensions which relate to income taxes which have been made by the government due to the coronavirus situation. We will understand the new tax regime for financial year 2021. During the budget of 2020, our finance minister announced an optional tax regime, a new tax regime, and we are going to discuss that. We will touch upon some exemptions which are available under the new regime, and then, like I said, we will discuss some tips on how you can brace, you can tide through this financial crisis that is upon us. So we will discuss all of that, right? So please do keep asking me your questions and I'll be happy to answer them. Now, here's a quick look coming up in the next slide on some important extensions which relate to income taxes. As you may all have already heard, income tax related exemptions were the first set of extensions that were made by the finance minister, and only yesterday there has been an update by the CBDT. There has been a new release, there has been some new notifications, and the timelines for tax compliance, for tax payments has been further extended, and let's take a look at those. Firstly, the last date to file income tax returns for financial year 2018-19. Remember, that's the financial year for which the due date to file income tax returns was somewhere in 2019. That period has already gone by. The last date to file this income tax return was originally 31st March 2020. It has been extended to 31st July 2020. So in case you haven't yet filed your tax returns for financial year 2018-19, you still have time to do so. You still have time to finish your compliance by 31st July, but you will have to pay penalty for delayed filing. So that definitely stays. There's no relaxation on that. Just that there has been an extension of the time limit. Another important thing for most salaried people is the due date for release of Form 16, because all our employers issue us a Form 16, and based on that Form 16 we file our tax returns. Now that there have been several extensions, employers have got more time to file their TDS returns, and therefore the due date for providing you this Form 16, the very essential and basic document to do your income tax returns, has been extended to 15th August 2020. That's an extremely long period of time. Therefore, your Form 16, which is a basic document for salaried people, which has information about salary paid to them, the deductions claimed by them, the tax deducted on their salary, and the tax deposited by the employer. That information, the due date has been made as 15th August, so you may not receive your Form 16 until some more time, which means your tax filing for financial year 19-20 could be further delayed. The other important change has been the due date to file tax returns for the financial year which just closed, which is financial year 2019-20. Original due date was 31st July. Of course, that's not going to happen right now because there are no Form 16s, and therefore that due date has been extended to 30th November as well. But in the interest of all taxpayers, I would like to recommend that the sooner you file, the sooner your return will be processed, and the sooner your refund will also be issued. So if you have any refunds due to you, it would be good to file your return as soon as you have all the relevant documents with you. Another important extension has been the extension of the last date for tax saving investments for financial year 2019-20. Now, remember that this is the first time in history that the government has extended the last date to do your tax saving investments. Earlier, one had to close all their tax saving investments by the last date of the financial year, which is 31st March 2020. But because there was a complete lockdown and taxpayers could not make those mandatory investments into their tax saving accounts, I'm sorry, just one moment. So therefore, people could not do their tax saving investments. They could not pay a visit to banks. They could not make those deposits to their PPF and NSE accounts. And therefore, the government has extended the timeline to 31st of July. For the first time in history, now you have more time to do tax saving for a financial year which has already ended. Therefore, this is an excellent opportunity for you to still save taxes for the year which has gone by. So if you've not exhausted your Section 80C savings, if you've not yet done your health insurance, if you still feel that you can save more taxes for the financial year which has already ended, then you have time until 31st July. So I would highly recommend that you make use of this time and make sure that you have maximized all your tax benefits during this period. You already know what your total income is going to be, because income will only be counted till 31st March, but tax deductions you can still claim, you can still make those deposits. So you can, if you've not completed your PPF deposit, if you still haven't made your NSEs, if you want to do life insurance, remember insurance is going to be for the coming period. It cannot be backdated, but whatever insurance premiums that you're going to pay, you will be able to claim them in financial year 19-20. So very, very important extension. I urge all of you to relook at your tax statements, to do your tax calculations, and to check if there's still some scope to do some kind of tax saving, that this is an excellent opportunity. Now, if you had any capital gains in the financial year 2019-20, then you can claim exemption on those capital gains by investing these capital gains either for purchasing a new house property, or if you want to make a deposit into a capital gains account scheme. So the time limit for that has been extended till 30th September. This is also a great move by the government, because those who want to invest their capital gains, they did not have enough window because of lockdown at several places. They did not have enough opportunity to do the reinvestment of their capital gains, and the timeline for that has also been extended till 30th September. So please make sure that you claim whatever capital gains exemption that you wanted to claim. In fact, even though the timeline is till 30th September, but it would really help to close this process as early as possible and file your tax returns, so that what really happens is, when you are buying a property, the buyer will deduct TDS before making a payment to the seller. So they deduct 1% TDS if the sale value exceeds rupees 50 lakhs. Now, even though you would want to invest your capital gains, the refund of TDS only comes to you when you filed your tax return. Therefore, even though there is an extension for reinvestment of capital gains, but still the TDS is stuck until you do your tax returns. Therefore, very, very important to focus on this aspect. If you had certain capital gains on which you want to claim an exemption, then your return filing should be sooner rather than later. Now, there is also a donation that you can make to PM CARES Fund for claiming Section 80G deduction. Now, this is actually the same old fund, but just the name has been changed from Prime Minister's National Relief Fund to PM CARES Fund. Everything's the same. Whatever donations you will make until 31st of July 2020 can be claimed in financial year 2019-20 itself. So if you want to make a donation, then you please do so and save taxes for the year which has already gotten over. The due date for linking of PAN with Aadhaar has also been extended till 31st July. Though most taxpayers who do their tax filing, I'm sure you all must have already linked, because it's a mandatory requirement. Without linking your PAN with Aadhaar, you will not be able to succeed at e-filing. So that's a very critical step, and I'm sure all of you have done so. Now, related to all these tax-saving investments, we get a lot of questions. People want to ask, what if during this time until 31st July, I want to make investment for financial year 2021, a tax saving investment for 2021? Can I do so? Absolutely yes. Whatever investments you make, the choice is on you whether you want to claim it in financial year 1920 or 2021. That choice is completely yours. Remember, an amount cannot be claimed twice. So that's very, very important. Whatever tax benefits you want to claim in only one of the financial years. And if you are claiming certain deposits that you have made now in the previous financial year, you want to claim it for the previous financial year, then you need to file a special schedule which is called Schedule DI, or Schedule of Details of Investments. So you need to tell the government while filing your tax returns that these are the various deductions that I actually made in the previous year, but now I want to claim them right now, right? So that is something you need to do. You need to look at what are the tax saving benefits that you want to claim, and you can then start reporting them in your tax return. Very, very critical to do that. Now, let's talk about the new tax regime. It's much talked about. There has been a lot of confusion on who should opt for the new regime. What are the contours of this new tax regime? Who does it apply to? So let's dispel all the confusions around it, and let's discuss how employees, as a salaried employee, you can benefit from this new tax regime and how you should approach it. Now, broadly, before we begin talking about the new tax regime, it's important to understand how employers are going to look at it, because ultimately it's your employer who will deduct TDS on salary payouts to you. So most employers will ask employees for choice of tax regime. I'm sure that process has already happened in your organization. It has happened in most of the organizations. So employees will then inform their choice of regime to their employer. If you fail to inform, or if your employer has not undertaken that process, you can safely assume that the old regime will be made applicable to you. So, which means as a default, your employer has decided to apply the old regime to you. Now, the choice of regime which has been made by the employee once to the employer cannot be changed during the tenure of your employment, right? So during the entire financial year, whatever regime you have chosen, you will not be able to change it, purely for the reason that for the employer it becomes a humongous exercise to recalculate your TDS and to ensure that TDS is deducted and deposited accurately. So the choice has to be made by you only once. But very, very important to note that irrespective of which of the tax regimes you have decided to choose, remember that you can always switch to the beneficial regime at the time of filing your tax returns. So you have chosen a particular regime, whether or not you are satisfied with it, you can, at the time you're filing tax returns for financial year 2021, which is going to be sometime in the next year, 31st July 21, is when you're going to relook at these two regimes, and you will check which one is more beneficial, and ClearTax will have a functionality where you will be able to assess which of these two regimes is more beneficial to you, and then choose the one that applies to you beneficially. So that option is always available to you. However, you may choose a beneficial regime, but if any excess tax has been deducted, that will only come to you through a refund through filing of your tax returns. Therefore, filing tax returns becomes an important process for the existing financial year, for the financial year for which returns will be filed in the next year. Now, of course, the most important question that comes to everyone's minds is, which is the regime that I should opt for. Now, we'll come to that in the next slides, but just to let you know that our analysis has revealed that a large number of taxpayers will benefit from being in the old regime, right? So a large number of taxpayers will benefit from being in the old regime, purely because, deductions can save their taxes, deductions can reduce their tax outgo. So this will be an important aspect for them. This will be an important exercise for them to, sort of look at which of the tax regimes are beneficial, and we're going to come to all of that in a bit. Now, let's talk about what are the various options through which you can save taxes in the new regime, right? Let's discuss tax saving options in the new regime. Now, employers' contribution to NPS is the only relevant deduction that has been taken into the next regime. So all those people who have an NPS account and they're contributing to their NPS account, and their employer is also contributing. Remember, the critical aspect is that your employer should also be contributing to your NPS account, and whatever contributions your employer is making, deduction for those will be eligible to be taken in the new regime, and these are eligible under section 80 CCD 2, where there is a maximum cap of 10% of your basic is what you can claim under 80 CCD 2 towards your employer contribution to NPS. So this particular deduction available both in the old and the new regimes, and this is the only one that perhaps most of us will be able to use if we have an NPS account. No section 80C, no 80D, no 80E, none of the section 80 deductions, no HRA, no LTA, none of that available to you in the new tax regime. And that's something that you need to understand and work through with your employer to make sure that you're choosing something which is more beneficial to you. Now, the other way to look at all of this is to understand that even though there is no 80C, but you can still continue to make your section 80C deposits. You can still continue to invest in PPF. You can still continue to contribute to Employee Provident Fund. You can do your Sukanya Samriddhi account deposits, and even though you don't claim any tax benefits on them, even though there's not going to be any 80C if you're part of the new regime, still whatever interest accumulations that will take place in this new regime, whatever interest accumulations take place in these various accounts such as EPF or PPF, they will continue to be tax free. So they will not be taxed, and there's not going to be any tax on withdrawal from these various schemes. So in that sense, even though there is no tax benefit at the time of deposit, the tax benefits on accumulation and on exit continue to be available to you. So withdrawals from NPS will be tax exempt up to a certain extent. Withdrawals from PPF, as always, have been tax free. withdrawals from EPF are exempt if you've had 5 years of continuous service. So therefore, remember that these several tax benefits continue to be very, very relevant to all taxpayers. Even though they may end up choosing a new tax regime, you can continue with all of these schemes. The other important tax benefits that are flowing into the new regime is leave encashment and gratuity. So leave encashment maximum limit is 3 lakhs, gratuity is 20 lakhs, but for all government employees, gratuity is fully exempt from tax. But for everyone else, if you have leave encashment and gratuity payouts, you can still claim the exemptions which are allowed to you on these. Therefore, these will be still eligible. VRS, which is voluntary retirement scheme compensation received, will also be eligible under the new tax regime. Remember that VRS is a very specific scheme, so it's not a generalized severance scheme. There has to be a retrenchment scheme. There has to be a proper retirement scheme implemented by the employer, which meets certain criterias, which meets the certain conditions laid down in the Income Tax Act, and that's only when it becomes eligible for this kind of a VRS benefit. So I hope you've understood the contours of what the new tax regime is going to look like for all taxpayers, and this is a broad outlay of what are the deductions available to you. It seems very disheartening that how come we just have one or two deductions available. But important to note that tax rates in the new regime are lower. So they are lower. There are more number of slabs, and you will have fewer opportunities to save taxes, but you still have a lower tax rate. So it's a nice play between these two things. It's a nice play between deductions and tax rates. So you need to make a right choice, and we will come to that. And I'm sure that the next question in your mind is how to choose a regime which is more beneficial, where you pay lower taxes. Of course, that's the regime which is going to be more beneficial to you. Therefore, we've done some analysis and we've tried to give you a sort of a benchmark that you can look at in terms of tax saving for the new regime. So you need to basically identify your tax break-even point. You need to look at, what is that point where your tax outgo between the two regimes is the same. So once you know what is that point where tax outgo between the two regimes is the same, and then you can sort of go beyond. So if you are seeing that tax outgo between the old and the new regime is the same, then if you exceed that deduction value is when you will have lower tax outgo by being in the old regime. I hope that has been clear, but I urge you all to look at an income tax calculator on ClearTax, where you can review these two regimes, where you can look at your tax outgo between the two regimes, and you can arrive at what are the taxes, what is the regime that you should be choosing. Now, looking at this kind of an interplay between deductions, let's try and understand at various income levels what is the minimum deduction that you will need to ensure that you have the same tax outgo between the two regimes. And like I said, this is very, very relevant, because if you go beyond this number is when you're going to save taxes by being in the old regime. So as you may know, like I said, just none of the deductions are flowing into the new tax regime. Therefore, important to also realize that no standard deduction. And only very recently, 2 budgets ago, is when the finance minister announced standard deduction 2 or 3 budgets ago, and now they have decided to roll it back as part of the new tax regime. A very surprising move indeed, because once you expect a government to come out with a tax policy, you expect them to stick with it at least for reasonable period of time, to continue with it for a reasonable period of time. But unfortunately, even standard deduction has not been allowed in the new tax regime. Now, here is a table which explains at various income levels what is the deduction you will need. Like I said, 50,000, let's assume you're all salaried or pensioners. Even pensioners can get standard deduction. Therefore, all of you will enjoy a standard deduction of rupees 50,000, and say at a 15 lakh income, if you do your deductions up to rupees 2 lakhs, is when you will have exactly same tax outgo between the two tax regimes. So the way to understand this is, if you do 1.5 lakhs of ATC and you have another 50,000 through either NPS or you do ATD, or even if you're reworking your salary with your employer and you're able to reduce your total taxable income through these means, take this total deduction or exemption value to 50,000 plus another 2 lakhs, is when your tax outgo will be exactly the same between the two regimes, and a little bit more is when you're going to save taxes. So definitely by being in the old regime is when you are more motivated to actually look at various tax saving opportunities, to be motivated to do some tax saving investments. And while we are talking about this, I feel for most of us an important takeaway is that as taxpayers, as investors, we need to stop looking at every investment from a tax lens. We need to stop evaluating each and every investment because of the tax benefits it brings to us. Because ultimately all your investing has to be very, very goal based. So you need to look at your investments from a goal standpoint, right? So look at what are your financial goals, look at what kind of risk appetite you have, and look at what are the kind of returns you are expecting. A lot of people tend to look at their investments through the tax lens. So they want to know, if I get into a particular product, will I have a tax benefit? And now is the time to stop doing that, to stop looking everything through the tax lens and to look at everything more from a financial goal standpoint, is when you will really benefit through this particular change that has been made by the government between the choice that has been offered between the two regimes. Now coming to an important and very relevant change, which is around maximum cap for contribution to NPS, EPF and superannuation. So what the government did was that, they said that, look, we know that there are certain high salaried people who are able to work their salaries in such a way that they do maximum contributions to NPS and EPF and their superannuations and yet have no tax outgo. Now those who are high salaried, they can look at creating a salary package in such a manner that they have a higher basic salary. So if you have a higher basic salary, then your PF contribution is a percentage of your basic. Your NPS contribution is also a percentage of your basic, and so is your superannuation. Therefore, those who are more senior, who are in their late 40s and 50s, who are looking at a shorter timeline towards retirement, may be able to work their salaries in a very beneficial way, contributing more to these retirals such as NPS and EPF, and having a lower tax outgo, and also at the end of their retirement they may be looking at corpuses, large corpuses, where the withdrawal is going to be tax free. So that has been an area of concern for the government, and what the government has done right now is to curb this practice, and what they're saying is that beginning 1st April 2020 there's going to be a maximum cap of rupees 7.5 lakhs for every employee. 7.5 lakhs is the maximum that your employer can contribute as an aggregate between these three things. So whatever your contribution, your employers, remember this cap is on the contribution made by your employer, not you. So maximum cap on contribution made by your employer towards NPF, EPF and superannuation is now capped at 7.5 lakh rupees, right? So this has, like I explained, this has been to make sure that high income earners do not end up contributing huge sums to their retirals, and then in a few years down the line they are able to make exits from retirals without paying any taxes on them. So that's it's been implemented to curb this practice. Earlier, so there are also separate limits. So NPS has a limit where an employer can contribute a maximum of 10% of salary basic plus DA. Superannuation had a limit of 1.5 lakhs per annum, but remember that limit has gone. So there is no maximum cap on superannuation. It's now within the overall cap of 7.5 lakh rupees. Recognized provident fund, we already know 12% of basic salary is what the employer can contribute, which the government has changed for a short period, has been changed to 10%. Beyond 12%, as you may already know, becomes taxable. So remember, employer's contribution maximum cap of 7.5 lakh rupees for contributions made to these various retirement funds. Right. Now coming to a very important topic on, bracing for a financial crisis. Now, a lot of, investors, taxpayers, individuals who invest in stock markets, their our balances have been completely hit. Our balances have been completely battered on the stock markets. It has been extremely volatile. It has been, it has been going uh, just falling like a pack of cards, and it has been a terrible, terrible situation for a lot of investors, for a lot of individuals. So, it's while we are talking about taxes and finances, it's important to speak in a very, sort of time conscious manner to understand what is the financial crisis that we are all facing right now and how we can prepare to tide through this. If we put together a small list of recommendations, and these will come handy for anybody, God forbid, if you fear a job loss or if you go through one, then these aspects will be very important for you to take care of. So, firstly, put a financial plan in place for this period of 6 months to 1 year. What this means is that you need to identify exactly, just take an Excel sheet and put together what are these expenses that you are likely to have in this period of 6 months. Absolutely bare minimum expenses that you will need in terms of rental payouts, or if you have EMIs, if you have whatever it could be, just basic grocery bills. You have, maintenance payouts, rental payouts, telephone, whatever kind of expenses you incur during a month is what you need to put together and estimate what your expenses are going to be for a period of 6 months to 1 year, and then prepare a highly liquid fund, which is easily accessible to you, which is in a liquid format. You can exit when you want to, and you can dip into your fund as your emergency savings. So very, very important to build that emergency corpus, no matter whether you are in a secure job or wherever you are placed right now. It's important you create this corpus should any kind of financial crisis fall upon you or any of your close contacts. This will come out really, really handy. So please do that. Also continue to invest, if you can, if you have that kind of money available to you. Please continue to invest and enter the market as it continues to bottom out. So, the bottoms are going to be there. It's not like the market has recovered. There's going to be more pain. So, it's very difficult to say when to enter, but keep on getting in. Doing SIPs is an interesting format of investing in the market to protect yourself slightly from too many highs and lows. So continue to do that. If you have a long-term investing goal of 5 years to 10 years, then of course you need to continue on that path. Don't drop off. Don't make any kind of hasty exits. A lot of us, make a mistake. We fear that the world is ending. There's going to be just like everything is going to come crashing down, and we make emotional exits. We feel that I'm going to lose everything, and it's all over for me, so I want to exit from the markets. I just want to get out of it. Please don't do that kind of emotional exiting from the market. Just hold your horses, have that patience, make a plan and stick to it. If you don't need the money, then don't pull it out unless you have a better option to invest it somewhere. If you have more money to invest, then of course, keep getting into it, because all these kind of variations in the market, these dips, are after a long period of time, after 3 to 4 years, we'll all look back and consider them as mere blips in the overall performance of the market. But you need to hold through this. You need to hold your patience, and also very importantly, we must all brace for more bad days. More bad days are likely to be there until we have a vaccine in place, until we have some kind of cure that comes through. There's going to be more pain as companies come up with their results. We look at what their performance has been during the lockdown period. There could be more pain coming up for the stock markets. So very, very important to be cautious of that. At the same time, to make more sound decisions, not hasty decisions, and stick with your guns and keep sort of holding it until this turbulence passes, until times improve for everyone related to the stock markets. Right. So these are, this is what we have for you. This is what we thought we'll talk about. I hope you found this session useful. At ClearTax, we keep doing a whole lot of webinars. We keep talking about taxes and investing, and I hope you've gained from this discussion. Today we had a very important and relevant discussion around choosing between the two tax regimes, looking at what have been the various tax extensions that have taken place, and we've also tried to understand how to prepare ourselves for what lies ahead, how to prepare ourselves for more pain that is coming in the stock markets. I hope you found this session useful. You can read a lot more on our website. You can research a lot more. Keep writing into us. Remember to subscribe to our channel where we continue with this important updates on taxes. And I hope you found this session useful. This was especially done for Kotak Mahindra Bank customers, together in partnership with ClearTax. And that's all from me today. Thank you so much, everyone, for joining in, and I hope to see you around soon on our channel. And remember to do your tax compliance on time, pay your taxes on time, and tax filing is going to be very, very relevant and important for all of us for financial year 1920. That's it from me. Goodbye. Thank you.